We're here in Monte Carlo for the Rendezvous de Septembre. For Invest TV, I'm Richard Banks. And I'm joined now by Jarad Madea, who's Chief Executive, Howden Capital Markets and Advisory. Jarad, good to have you with us.
Richard, very much appreciate the invite and great to be here with you.
So listen, we're here in Monte Carlo. Lots of talk about the market conditions. At this point in a hard cycle, we typically expect to see startups activity. We haven't seen that this time around. Why not? And what are the consequences of that?
Great question, and probably even 2 years ago when the market got very hard, I think there started to be conversations around will there be startups or not, and we haven't in the last 2 years seen a large wave of that. I think there's a number of reasons why. That being said, I think we will see a few get done. I don't think it's an all or nothing. We won't see a large wave like we saw after 9/11 or after KRW, but I think we'll see a few get done here or there. So what's the reason for that we won't see the large wave? I think it's probably 3 or 4 reasons. One, I think traditionally we saw private equity in the market leading those investments. I think some private equity that's experienced in balance sheet investments is already in. Some of them came in 2020 and already have picked their horse. I think there's a number of attractive investment opportunities out there right now for private equity that are outside insurance or outside balance sheet investments. Maybe that's MGAs, maybe that's distribution, brokers, wholesalers, and other. So I think we'll see some playing there. Then when they look at the reinsurance business, I think they see cycles. And right now we're in a reasonable cycle where pricing's here. But does that stay here? Does it start to come down? I think the length of that cycle concerns them a bit to where they may not come in. That being said, we will get some done with high quality operators. I think the other thing, we've seen capital come in many different forms and many different structures. So that's whether it's sidecars, Lloyd's, FAL investments, cat bonds. I think we have seen that capital come in over the last few years. I think we're actually in a good place where we've spoken to those investors, hear their needs, whether it's liquidity, whether it's duration of the investment, whether it's risk being lower, returns here. How do they evaluate those 4 factors? And I think at this part of the cycle, they've come to play in our space, in the reinsurance space, in a different way. And I think the market has evolved a lot to offer those different structures that allow them to come in, not just with balance sheet, you're in a private vehicle for 5 to 7 years and uncertain over the exit. So I think the market overall has developed to allow folks to still come in the traditional balance sheet play, but also come in sidecars and other vehicles right now.
So does that affect the longer term consequences of not having startups? In the past, we've seen that M&A activity has resulted. There's been opportunities for ambitious underwriters. What does that mean longer term?
I don't see any negative consequences of this. I think it probably is bringing a more stable market where the traditional balance sheets that are in there, the private equity money, I think there's more family office money, more sovereign wealth money, more credit money that can come in and play in these different structures. And I think it allows for more orderly market over time that may take out some of the cycles, but allow more efficiency in the market where we are. On your question on the M&A side, or comment, I do think, Richard, that we will see more activity in balance sheet M&A over the next 12 to 24 months. I think there's a number of factors leading to that. Where organic growth is slowing a bit right now, where you have some of the carriers have had strong two years behind them, where they're building up excess capital. I think their valuations and currencies are at reasonable levels that they could use currency of either whether it's cash or their stock to do deals. And we had a lot of financial players come in 2020 who have bets on the space, and they'll be looking for exits over the next, whether it's 1, 2, 3 years. So I think we're at a position now where the market is healthy, and we will see M&A that we haven't seen on the carry side in the last few years.
So there's been a lot of talk over the past few years about ILS money being a partner to traditional reinsurance money. Right. Now, as the reinsurance market has sort of rebalanced a little bit, moved up the ladder a little bit, are they back in competition again?
Great question. I would probably say I still see more of a partnership between traditional reinsurers, balance sheets, third-party capital providers, ILS. I do think it's a healthy part of the chain. I think there's been a number of lessons learned over the last decade, and I think we're in a place now where I do think there is healthy collaboration between them. A number of the balance sheets and reinsurances businesses own ILS managers, or even if it's not an ILS manager, they bring in and support and have a number of different vehicles that go in and attract third-party capital. So I think it is really in collaboration with each other. At different part, and again, I go back to different parts of the chain and the different investor universes, whether it's an on-balance sheet investment, whether it's a credit investor who wants to play, whether it's a hedge fund, and we've had some hedge funds come in, and they may not be in for the long term, and I don't think that's a bad thing. I think the way we've been able to involve the market, broaden the investor appetite to come in the reinsurance space, I think is good, and it doesn't have to be one size fits all of I need to come in a permanent balance sheet vehicle. Yes, we'll continue to have that, but I think it's healthy that we have hedge funds come in and maybe play a market here or there, and we have other investors, whether it's sovereign wealth or family office, that come in and play a longer duration as well. But I think it's all very much in collaboration with each other. That being said, there will be competition and healthy competition in the market, but I think we have that.
So some great insights there about the supply side. What about the demand side? How well is the industry as a whole, ILS and reinsurance, gearing up for the challenges that its clients are facing?
Yeah, the demand side, that's great. Obviously, there's a lot of risk out there in the world, whether it's climate change, whether it's unfortunately war, whether it's severe convective storm in the U.S., whether it's floods, whether it's cyber. There is a lot of risk out there. And throw in inflation, throw in social inflation. There's a lot of factors driving the increase in demand from our clients. And I think the needs are largely being met. That's not to say we can't do better, and we should do better and will do better in terms of innovating new products and new solutions to keep prices down and to help those clients. I think the industry is doing that, and it's not easy. There continues to be more demands and more sort of threats out there and the need for insurance and reinsurance. But I think the industry is doing a good job, and that's why it's good to see these different sources of capital to be able to come in and creatively solve and provide that capacity in different situations and different forms.
Brilliant, thank you. Jarad, thank you very much indeed for joining us.
Thank you, Richard. Very much appreciate it.
For Invest TV, I'm Richard Banks.